We'll be looking at the break-even and profit-volume analysis for pricing decisions. One of the practical area examinable and also that shows up in practice. Break-even covers the whole range of financial data analysis. It covers a chunk, a whole range. It's an analysis that includes the calculation or calculations associated with break-even, pricing, and determining the margin of safety. So we'll be looking at them bit by bit. Break-even covers the identification of a contribution. Contribution looking at what each unit or each component of an activity or product brings to the table. So when they say, what do you bring to the table? We are looking at the contribution that a particular component activity supplies or contributes to a particular either revenue or cost stream. So identifying fixed, variable costs, and the revenue associated with a proposal or an order to determine break-even point in terms of either sales revenue or the equivalent number of units of production. Okay, yes, please go ahead. Feel free to interject. Sorry, your network was breaking. I'm not catching your thoughts.
Okay, the slide before now, you know.
Oh, the slide before. Okay, break-even analysis. All right. This one?
No, I don't. It has not changed here. The first one where it says it covers a whole range of financial data analysis and includes the calculation associated with.
Okay, with break-even pricing. Okay, this slide. Okay. I wanted to see something on that slide. Or you want me to go over it again?
Okay.
Sorry, you are breaking.
It's okay.
Oh, okay. It's okay.
It was terrible.
Okay.
Margin of safety. Yeah.
Okay, you're trying to look at that margin of safety, right?
Yeah, I remember it.
Okay. All right, so the break-even analysis covers a whole range of financial data analysis, and margin of safety is part of it. So, so we'll be looking at the activities that contribute to a product or a service and the contribution of either product lines or revenue lines that contribute to fixed and the variable cost of a component or an activity. And this is associated with orders to determine break-even point in terms of sales revenue or the equivalent number of units of production. So candidates, potential chartered accountants should be aware. Yes, please.
For something you are saying that when it talks about what you bring to the table, it has to do with contribution to, like, is it contribution to the sales, or is break-even really just about the income part?
Okay, so break-even is a middle point where you neither make profit or loss. That's what it means to break even. Yes, it's essentially, we'll come to that, but let me just define it. It means you are at a middle. You are at a safe end. You are neither making loss or profit. So your cost is equals to your income. That's what break even means. So there is no more, no less. While contribution talks about what amount, actually contribution has two definitions, and we'll be looking at that subsequently. So in management accounting, you have it as fixed cost plus profit is an automatic contribution formula, while selling price minus variable cost is contribution. So those two formulas, you could use it to compute contribution in marginal costing, in management accounting. Those are two ways you could get contribution. Then also another way contribution could be derived or explained in management accounting is you have maybe a product line of 5 products. what is the contribution of those products to revenue? So which one is contributing a higher percentage? So for example, you have locks on a product line for maybe PZ, and you have Joy on that same product line, you have Imperial Leather. So out of those three, which one contributes much more revenue? That's another area you can look at contribution. So you have a revenue of 100 million. How much did Imperial Leather contribute? How much did Locks contribute? Yes, how much did Joy contribute? So you're looking at that in that aspect. But in the management accounting, there are two fast formulas to check or calculate contribution, and that is fixed cost. The costs that don't change plus your profit, yes, you get contribution automatically. Then you can also calculate it by saying variable selling price minus variable cost gives you contribution automatically. So we'll be looking at that as we go subsequently. So that's just a brief explanation on contribution. I hope you're a bit clear now. It will be clearer when we move on.
Okay, sir.
Yeah. Okay. So we need to be aware that an approximation of contribution can be gross profit less direct cost, and this is where we come in. So gross profit, looking at your profit less direct cost, and that in many circumstances, sensible approximations are a critical factor in good financial data analysis. So you could approximate, but then your selling price or your profit, gross profit less direct cost, can approximate your contribution. Where in management accounting, mostly you don't have the contribution margin calculated from the SCI. You have unstructured data like selling price, variable cost, fixed cost. Even though variable costs are also direct cost, yes. So you could also use that to calculate your contribution in financial data analysis. So it is also worth remembering that over different time periods, the definitions of fixed and variable are somewhat elastic. What does it mean, elastic? That is, in real life, all costs can change. That is variable over time.
It's a change.
Yes, exactly. So it can be changed, it's not static. While pricing, this is the corollary of the break-even point, the price, and the same general points apply. So where, for example, the business want to identify the lowest price at which a new or even an existing product may be sold, but it doesn't want to create a loss on that sale. It may be particular or very keen on trying to survive a pricing war or competitors that came into the market, especially during recessions or depression period. So pricing is very important. Now, a company may not want to make loss, but they will want to just break even. Let's have our costs and income or revenue as the same. So break-even decisions may be predicted based on calculations to arrive at just giving the product to break even, not to have lost. So that's why break even at times come as a calculation for businesses to identify a price and let it go at that price, either for an existing product or for a new product that is just launched into the market. So the product may be sold, but they don't want to have a loss of sales, so they calculate a break even and just let it go like that due to some factors that are inevitable. Now for margin of safety, which you talked about and you just remembered humorously, indicates how much sales can decrease before a loss occurs. So margin of safety means the safety or the threshold level where your sales can deplete and a loss can occur. So the volume of sales may want to be buffered or pushed to a particular level so that sales or losses will not be incurred by the company. And that's what is called the margin of safety. What additional sale volume can we sell so that we don't incur a loss or drop below a particular level? So let's have a safety level. And that's what that margin of safety is all about. I know you can remember it now. So it is the excess of budgeted revenue over break-even revenue. The network is not allowing me hear you. You said?
I really don't understand it.
Sorry, come again. Your thoughts. I'm still struggling.
It is my network.
Yeah, your network is. Yes, it will come, it will go off. It will come, it will go off.
I did not get it.
Okay, I had that. You say you don't get the margin of safety, right?
Yes.
Okay, so where you have a break-even point, the break-even is the point where you are neither making profit, you are neither making loss. So your cost is equals to your income. Now, the margin of safety is what will you do extra to stay at that break-even and not drop to have a loss. And that is the margin of safety. So it is the excess of budgeted revenues over break-even revenue. So a little bit higher to be safe, because if you are breaking even, there is vulnerability or there's possibility that you may slide down to make a loss. So what do you want to do? What do you want to project your revenue or add to your sale volume to take you above the break-even so that you don't slide to loss? A loss position is what margin of safety is. Okay, so I'll give an example so that you buttress it. So you need to sell 200 packets of matches to be able to break even between the cost and the income. So 200 packets is different. Is the volume, sales volume you need to break even. Now, that 200 packets, if something goes wrong, you may not break even, you slide into a loss. So you may slightly have a margin of safety to say, I need to sell 210. So that will be a little bit above the break-even level. Yes. So your sales volume, so you don't want to stay at break-even level so that in case something happens, business volatility, current economic trends, because this is like a projection. Most of these are calculations projected towards sales activities. So you now project that to stay safe, instead of 210 packets of matches, let's add 10 to the volume so that we can break even and stay at a safe place. We are not making too much profit, even though the profit is slightly above break even, at least we are safe. If anything happens, this buffer is also called a buffer. This buffer margin will keep us safe and we have at least a comfortable break even level. I think it's a bit clearer now, right?
Yes, that is clear.
Okay, fantastic. At least a way of recap of reminding you of margin of safety. So an additional development within this analytical heading is the calculation of a margin of safety, which provides an indication of the level of risk, not only with projects under consideration, but also importantly indicates the size of the cushion for errors. Exactly. So where maybe a calculation for break even, there was an error, the margin of safety will cover for it. So where in case you have an error and you slide down to a loss, the margin of safety will help you at least balance that calculation. And that is why it's good to have a margin of safety, at least either in volume or in revenue, sales volume or in revenue at amount, so that you are safe, and that is what is called a safety. So the objective is, I don't want to make a loss, and I don't want any activity or any situation that will push that company to a loss. So we have a cushion, we could have errors, and we can have uncertainties also. So to cushion or mitigate against that risk of uncertainty, a margin of safety in terms of volume or budgeted revenue will help mitigate this. So as with any issue relating to profitability, the greater the risk of profit becoming a loss, or the smaller the margin of safety. Exactly. Yes. So the greater the risk. Yes. So as with any related issue with profitability, now we're not looking at revenue or income, We're looking at profit. Now, if you don't want to profit, if you don't want to make loss, yes, you have to have a small margin to stay in that break even where you don't make a profit or you don't make a loss. Even though above break even level, even if it's 1 naira, you've made a profit, but that profit may not be significant. But then it is a margin of safety that indicates you made a profit, but you didn't make a loss. And mostly that profit is insignificant. It's very low compared to what in business terms you budget to have as what is called profit. So in terms of profitability, that margin of safety may not be called profit. Yes, that's what this means. Okay, so the more critical each of the estimated figures become, and that is why the margin of safety is very, very important. So in estimating for any revenue or budgeted revenues with any product or service in the market, the margin of safety should be factored in. Very important to caution against any unexpected loss. So to use an example or a parallel example for the world of audit, yes. So from the world of audit, the smaller the leeway between achieving a profit or suffering a loss, the more critical is the determination of level of materiality for that audit. Exactly. So in audits, for example, when auditing, you need to provide a cushion. That's what is called a leeway. So you are not achieving so much profit, but make a little profit to avoid suffering a loss. Make a little profit. But if you decide to break even and say, I don't want profit, I don't want loss, there's a possibility of sliding into a loss. So the materiality concept comes in because materiality talks of size and amount. Now, your profitability in margin of safety situation is not a large size you are making. You just want something marginal. Marginal means small, that will take you between that line of loss and make you comfortable a bit. So, for example, the line of loss is 200. So you just want to move from 201, 202, or at most 205, so that you'll not slide to 199 or 198. After rounding up the figures. So you want to be safe. So even if they round off from 205 down, you stop at either 201 or 202. It is not material. The profit is immaterial, and that is what this illustration means. Okay, so method of calculating the break-even point. Yes. Okay, so the break-even point is when total revenue and total costs are the same, or they are equal. Exactly. That is, there is neither profit nor loss made. There are three methods of ascertaining the break-even point. Number one is the equation method. The equation method is a mathematical method that can be used in solving numerous different cost, volume, profit questions. So you are equating your revenue and your cost. We also have the contribution method. So like you saw, the equation method is your revenue is equals to your total cost. Simple. Everything is equal. While the second method is contribution margin method. This approach uses a little bit of algebra. Yes. This approach uses a little bit of algebra to rewrite the equation above, concentrating on the use of contribution margin. So this contribution margin is not the contribution of what somebody brings to the table. So the contribution margin is using those two formulas I mentioned, either fixed cost plus profit, depending on the scenario, or sales price minus minus sales variable cost. Yes. So the contribution margin is equal to total revenue less total variable cost, not the total cost. Total variable cost is the indirect cost, while fixed cost is direct cost. So total revenue less variable cost is contribution margin. Alternatively, contribution margin is looked at as selling price versus variable cost. Why are you not using revenue? Revenue may be the volume times the price, sales volume times the price. and that culminates in revenue. But the actual calculation should be selling price and or minus variable cost. Exactly. So unit selling price, which is your selling price less your variable cost, is your contribution in price. Then you have a volume amount that you use for that activity. You can now times the volume to have your total revenue by your variable cost. So the contribution margin is predominantly used than the equation method. This one is the predominant, and this is what the examiner mostly tests. He hardly uses the equation method or the graphical method. He uses the contribution margin method. So try to recap and remember that the contribution margin is predominantly used in practice and also in the exam. Exactly. All right, so the graphical method, we used it in school, but it's not applicable in practice. It's just a theoretical method of calculating break-even. The total cost is where equals total revenue, and there's lines plotted on the x-axis and on the y-axis, and where both of them intersect, you have break-even.
That's the break-even
point. Exactly. So where the points intersect between the x and the y-axis looks at the amount of profit or loss at different output levels. This is presented by the distance between the total cost and the total revenue, and that's where you have the graphical method. Yes, break-even. So we have alternatively a contribution graph also could be used, but the examiner will not ask you in the context of the exam, and also in practice they hardly use graph. So what is practical? Yes, so what is practical is the contribution margin method, where you just calculate practically your sales price minus your variable cost. So alternatively, the graph contribution could be drawn, and that would look that will be a total wrap-up of the three methods. So take note, we have the equation method, where total revenue equals total cost. Yes, that is equation method. The contribution method, where you have revenue less total variable cost, that is selling price mostly less variable cost per unit. Yes, per unit, exactly. Then the graphical method is a theoretical one that we used in school, where we carry graphs to check the y-axis and the intersection, and also plotting the contribution graph. So number 2 is predominantly used in practice. All right. So also in terms of break even, we are looking at the cost to volume profit. The cost is the price. Yes, the CVP. So the cost is the price, which could be the selling price or the cost per unit. And the volume is what you need to sell. What you need to sell, the volume of your product or service you need to sell to be able to break even or make that short marginal profit to stay as to make as a margin of safety. So this analysis is primarily concerned with the effects of differing levels of activity on the financial results of a business, and that is what the CVP is. The cost looks at the per unit price of that item. The volume looks at how many you're supposed to sell. Then the profit looks at the margin you're supposed to make to stay safe. And this culminates in the level of financial results of the business. So CVP analysis is helpful in demonstrating the effect on an organization that changes in volume, in particular costs and selling price, what they have on profit. How do the cost and the volume of your activity, how does it impact on profit? So one of the most important decisions that need to be made before any business starts is how much do we need to sell in order to break even? Exactly. And that's why the break-even analysis comes. It's a forecasting technique. What do we need to do? Most businesses start with a loss, but smarter businesses ask that question. What do we need to do to sell and break even? That's we are not making a loss and we are not making profit, which means covering all costs without making profit. So startups that will do well ask these vital and pertinent questions. So, and this analysis is known as CVP, or cost volume analysis. So the reason for the particular focus on sales volume is because in the short term, 1 month, 1 week, one day, is that selling price and the cost of materials, which are direct labor, are usually known with a degree of accuracy. Exactly. So in the short run, you may not know it in the long run, 6 months, 3 months, but within a day, a week, a month, you know how much these components sell in the market. You know what is the cost of these materials before they go above a particular price in the market. So in the short run, you know the selling price of materials, direct labor, and these are known to a particular degree, and you can predict them. While sales volume, however, is not usually predictable, and therefore in the short run, profitability often hinges on sales volume. So if you know the price you bought the item, now the sales volume, how many do you need to sell in the market? Will the market accept it? If you say I will sell 200 bags of soap, are you sure you can sell those 200 bags? And that's that 200 bags you need to break even. So you can predict to some extent the volume you will sell. Depends on activity and how much you can drive your sales by marketing, promotion, and a lot of factors that determine how the sales volume will be, or result, or your outcome. So this cost volume analysis will help you to be able to at least break even, and the essence of the objective of the CVP analysis is for you to break even. So a popular question a businessman will ask is, will the company make a profit in that year? Often the answer is, we don't know, because this is not a practical question. It's a rhetoric question because you don't know whether you break profit, especially as you are starting up. Why don't you know? Is because the sales volume that will be achieved in that year is not clear. You don't know. It will depend on market forces. This is very important. But you can work out the volume of the sales the business needs to achieve in order to make a profit. And this is where CVP analysis begins. So if we need to make profit with a particular number of volume, then we will drive that volume and see how to achieve selling that particular volume in the market. So since we've determined our sales price, we know our cost of materials, then the volume and working to make that volume visible and acceptable in the market is the next task. So apart from ascertaining the break-even point, there are other routine calculations that are just as important to understand. So not just break-even point is important, we need some other components. So like a business wants to know how many units it must sell in order to attain a target profit. CVP analysis will help us do that. Very important. So aside break-even point, some business may be overambitious to say, let's even make profit in this first year. It may not be significant, but low profit, not even profit to stay safe or have a margin of safety. Some profit that we can be happy that in the first year of operations we made profit. Some business can be that ambitious. So a business will want to know how many units of its product it will sell to attain that particular targeted profit. And this is not practically impossible. It may be possible in some industries and some particular circumstances. So there are limitations, however, of this CVP analysis. The use of CVP analysis is limited based on some of these assumptions. Either a single product is being sold or multiple products are sold in a constant mix. And this is where that other definition of contribution comes in. So if it's a single product, fine. But where there are multiple products, what is the contribution of each product to the whole mix? This is one of the assumptions or the limitations of CVP. You're looking at all other variables, apart from volume, that remain constant. Volume is the only factor that causes revenue and cost to change. Exactly. So the volume, what you produce and what you sell, could change based on what is needed to be injected or provided to the market. So apart from volume that remain constant, volume is only that factor that causes your revenue and your costs to change. So in reality, this assumption may hold true, as for example, economies of scale may be achieved as volumes increase. So as the market accepts the product, you have volume increase. Similarly, if there is a change in the sales mix, your revenue will change and your volume may not change in the market. So it's often found that sales volume, if they increase, price must fall. So sometimes the higher the price, the lower the volume. But the lower the volume, sometimes the higher the price, depending on market forces. So the total cost and total revenue functions are linear, in the sense that they likely hold in the short run and restrict the level of activity. So what does that mean? It means that the total cost and total revenue functions are dependent on your sales volume. Very important. So how much you sell will determine what revenue you generate and also what cost you incur. That is what it means by the linearness of your cost and your revenue. Very important. So take note of that, and it's likely to hold in the short run, because in the long run you may not be able to predict what will happen due to internal and external business factors. So cost can be divided into fixed, that is direct, and variable, indirect components. In reality, some costs may be semi-fixed, like telephone charges, recharge card, phone expenses, whereby they may be fixed monthly rental income and a variable change for calls made. And also fixed costs remain constant over a relevant range, that is level of activity in which the business has experienced, and can therefore perform a degree of accurate analysis. So some fixed costs that are fixed in nature may change over time, while some variable may be fixed also, but in the short run, they don't change. We may look at it in the long run, maybe after 5 years, 3, but in a particular period, monthly, quarterly, they may stay at that status of variable and fixed. So it will either have operated at those activity levels, that's the fixed and the variable costs, before you study them carefully to know whether they have changed from fixed or they've changed to variable over time. So monitoring and accurate predictions are very, very important. So quite a technical level and a bit dicey, but then break even looks at the point where you neither make profit nor loss, where total revenue is equals to total cost. And that's what generally break even is all about. And margin of safety is looking at a particular unit or a safety level to make smart profit so that you don't slide down to loss. And that's what margin of safety concept is about. Then cost volume profit looks at how much selling price do you need to place on your product to achieve a particular targeted profit, and how much do you need to sell in quantity of your product to achieve a particular cost or revenue. So cost can be incurred based on the volume you placed on that product, and revenue can also be achieved on the volume. So both of them are linear. They are either mutually dependent or mutually exclusive. The volume of whatever you sell in the market depends on it. And also the price. The higher the price, the lower may be the volume, depending on the market and the preferences in the market. While the lower the price in some markets, the higher the volume. So that's generally the concept of the break-even and profit volume analysis for pricing decision in financial data analysis. So we've been having a good conversation before you came in, Aisha. It was actually engaging with Salmat. though her network was actually a challenge, but then I was able to catch one or two questions and contributions she made on this subject. So these are examinable area the examiner tests very frequently. And I think these your mock exams have a little of this financial data requirement too also.
Yeah.
So yeah,
No,
so
ready
please. So you've not read the mock exams?
BP fashion. I will I pretend
Really? You don't have time, but today is Thursday. You have from now till Sunday, so you better read it before you start answering. Yeah, it has some of these components in it, so please look at it and let's decipher it together. So, any questions? Do we have any questions on this break-even or any contribution, observation? Okay.
I think I have a question.
All right, please go ahead.
So I think I am in between CVP and margin of safety, because we said margin of safety is just that the little profit you get just to stay above your break even. That's just to avoid running into loss where you're a little bit above the break even point. So you did not you're not going left hand. Then the CVP now. Then the CVP is how much volume can you sell that will make you stay above, that will make you get how much volume can you sell that will make you realize the cost of your production. So this I want to understand, CVP does not necessarily need you to be above your break even. It's just to be able to turn around your production cost. Just being able to achieve your production cost. I think my network is breaking.
Yes, so I'm getting you. I understand you absolutely. I'm hearing you very clearly. Yeah, I'm hearing your thoughts. Go ahead.
Okay, so my point is, margin of safety is about you making profit that is above the break even if it is 1 naira. Why the cost volume profit is that you sell volume. You sell quantity that helps you get your cost of production. Like whatever you have put into production, you should be able to gather it back from the quantity you sell. Is that correct?
So that's one. Yes, it's correct, but one aspect is correct, but not totally correct. So you have one aspect. There are multiple scenarios in the CVP analysis. So that's one, to cover your production cost. One area to also break even. How many volume do you need to sell? What price? What cost do you need to incur? What volume do you need to sell to be able to cover your production cost and break even is one aspect. Then another aspect is what cost should you incur? What volume should you sell to be able to make a targeted profit? Like in the course of lecture, we said, some people can be overambitious. A business can decide, okay, we don't just want to break even. We want to make profit in the first year. Yeah, it's doable. It's possible.
Okay.
So CVP, so CVP also covers that area where, all right, I want to make 20% profit in the first year. What volume do I need to sell? What cost do I need to incur? What revenue do I need to make? And that's where CVP analysis comes in. So from your observation and explanation, yes, but that's one aspect. CVP does not only cover your margin of safety or your break even. It also covers targeted profit. If you target a particular amount of profit in percentage and in amount, you can also work towards that. Even in your first year of launching a business, yes, it's possible. There are businesses that have done that. They launched the business and their first year, they made profit based on the cost and the volume and the analysis they did, which is very rigorous. And they came about a positive bottom line and profit. So yes, you are correct. Cost, volume, profit looks at break even, looks at targeted profit, and also looks at margin of safety. Exactly.
Margin of safety.
Yes. All right. So any other question? Aisha, do you have any question on this? Aisha, you're muted if you're speaking.
Okay, not yet. I came in towards the tail end, so.
Yeah.
But I get your explanation from Selma's question. So let's see how my understanding does.
Oh, fantastic. Fantastic. All right. So let's quickly look at our quiz question for. Yes, please go ahead, Salma. You're trying to say something.
No, I just said quiz again.
Yes, so for break-even and profit volume analysis. Yes, so our quiz is around. Yeah. So let's test the understanding, and you really engage. So I believe you should get 100 over 100 in this one.
Okay.
Okay. All right. So number one, what does the break-even point represent in financial analysis? The point where total revenue exceed total cost. B, the point where total revenue equal total cost. C, the point where total variable cost exceed fixed cost. D, the point where total fixed cost equal total revenue. Okay, S said B.
It's B.
It's B. Where total revenue equal total cost.
Equilibrium. Yeah, B.
Yeah.
Okay. B. Right.
Economist.
All right. Which of the following is not a method for calculating break-even? A, the equation method. This one is not to look at not. B, the graphical method. C, the cost absorption method. D, the contribution margin method. Which of the following is not method for calculating break-even?
C, the cost absorption method.
Okay.
Really?
A, what's your pick? No, that's her pick. Oh, don't ask her. Make your pick. She was not in the class now, so she wants you to give her a clue. So you are on your own now. Salmat has left you.
It was us.
Salma, don't give her a spoon. Let her guess. Yeah, hey, make your pick. No crowd for
I
you
know
today.
geographical method is there. I know contribution margin method is there. But I'm not sure of cost absorption. And then what is equation method?
Yeah, so you have
equation method is like simultaneous equation is coming to my head and elimination method. Hey God, what MTN
one. It was MTN that cost it.
Yeah.
Sorry about that. You may have to guess now.
Oh, I'm just gonna guess. So I'm not going to follow Sam. I'll go with A. Let's see what happens.
Okay.
Stand alone. I like that. Very good. So number 3. She doesn't want to join the crowd. Yes. It's good. Stand alone, die alone, eat alone, die alone. All right. Number 3. In cost volume profit analysis, why is sales volume considered critical? Because it directly affects material cost. Because fixed cost change based on sales volume. Because selling price and cost are often predictable, but sales volume is uncertain. D, because higher sales volume always leads to lower costs. In CVP analysis, why is sales volume considered critical?
Okay.
Affects material cost. Sales volume.
I'll go with C. You can't. You can't really estimate the volume of sales. It's uncertain.
So Salmat is with D, right? I'm hearing D.
No, it's C. This
okay,
is a second thought to it, because the higher the sales volume always leads to lower cost.
Okay, so you are going for D.
Yes.
You are going for D, right?
I remember this. Yes, D, because the higher the sales volume, it leads to lower cost, and when there is higher price, it leads to low sales volume. Yes, I'm going with D.
Final answer.
Let me get my pen for that.
Stand alone. Like Aisha left.
All right. So Aisha C, Salmat D. Okay, so let's go. Number 4. What does the margin of safety indicate? The excess of budgeted revenue over break-even revenue. The minimum revenue required to break even. The difference between total cost and total revenue. The level of fixed cost compared to variable cost. What does the margin of safety indicate?
What the formula? I think that's contribution divided by sales, right?
What is answering you in the example? What do we answer?
B. I choose B.
Okay, Salmat is going for B. So we're waiting for A. What's your pick?
Let's continue.
What does the margin of safety indicate? Excess of budgeted revenues over break-even sales, break-even revenues. The minimum revenue required to break even. The difference between total cost and total revenue. The level of fixed cost compared to variable costs.
Oh my God, this is
tricky. So make a pick.
Oh, let me not waste too much time. Let me go. I'm going
there too.
I'm sorry?
So I think he's going to win us in this set.
Yeah, so it's very possible. You guys, I'm going home with some points. You can't score 100. I'm very happy with that.
I need to revisit this video,
Yes,
this class. I think I'll go with B. Minimum revenue required to break even. Final answer.
Final answer B. All right, finally, which of the following is a key limitation of CVP analysis? It assumes all costs are fixed. It assumes sales mix remains constant. It ignores revenue generation. It applies only to large businesses. Which of the following is a key limitation of CVP analysis? These questions are hot. They are not like...
Not give us the ones we
know. I don't know. We'll just get the guess. It's going to be A.
They are hotter than okay. They are hotter than financial forecasting and budgeting. All right, Salmat, what's your picks? Aisha has picked A.
CVP is cost for them. Profit analysis.
What's your pick? Salmat, we're waiting for you. They are going for me. Yes, I think this
looks familiar.
Yeah.
I'll sleep very well today. I have.
You should sleep well because if you feel like this, you feel like you've lost really hard.
You did very well now in financial forecasting, 80. Now you did 100. So let me have a nice time in this one too. All right, so end of the quiz. Yes, now. So let's go. Judgment day. Number 1, B. Wow, they got it. What does the break-even point represent in financial analysis? The point where total revenue equals total cost. Exactly. Yeah. So the break-even point is the level of sales at which a business neither makes a profit nor incurs a loss. It is the point where total revenue from sales matches total cost, both fixed and variable. Exactly. So nice one. All right, so let's go to the next. Number 2. Which of the following is not a method for calculating break-even? Exactly. So she guessed, and her guess was wrong. So Salmat was following the class. That was why, because we really spoke to those 3 methods. So the equation method looks at where total revenue equals total cost. So the equation method is not necessarily the simultaneous equation. So is the equal, that's what equation method means, where is equal, cost is equals to, So you can see from the explanation, the equation method A calculates break-even using a formula that sets total revenue equal to total cost. That's what equation method means. While the cost absorber method is related to full costing, not break-even analysis. It includes both fixed and variable cost in product costing, but is not typically used to determine break-even. Exactly. All right, so number 3, in CVP analysis, why is sales volume considered critical? Yes, it's only A that got it. Salmat said D. So in CVP analysis, sales volume is critical because selling price and cost are often predictable, but you cannot predict sales volume now. I was surprised that you didn't catch that in the class. So sales volume. So for example, you have the price of locks in the market. You know the cost of those materials, but you cannot predict how many you sell.
You
If you say you sell, yes, you cannot predict it in the market. It will depend on a lot of factors. And that is why sales volume is always uncertain. And that is one limitation of CVP analysis. CVP analysis assumes sales volume is certain, which is a limitation. In practice, you cannot determine sales volume. Sales volume depends on, number 1, market demand, exactly, competition, economic conditions, while selling price and costs are usually known with some level of accuracy. Exactly. So, A guessed right, and D, Salmat guessed
I
wrong.
didn't guess this one.
Okay, you certainly knew it. Fantastic.
No, I use
Elimination method.
No. I just use logic.
Okay, use logic. Okay, your logic worked. And it didn't work for Salmat. All right. Okay, so number 4, B. Both of you failed it. This is what does margin of safety means? And Salmat was stressing margin of safety. I'm surprised she still failed it. So margin of safety is the excess. So the excess does not mean how much. It just means a little bit above. But that excess was what confused Salmat. She now went to pick B because we really had a conversation on that in the class. So margin of safety measures how much sales can drop before the company start making a loss. The higher margin of safety means lower risk.
No, that's why I think the minimum revenue required, because to break even, because I even wrote something that you said increase volume of to increase the volume of sales to either maintain it or be slightly above it. So your budgeted revenues over break even is not it, because that is just a budgeted excess. But here it says the minimum revenue required to break even, like how much more do I have to make to either break even? Is either I remain in break even or I move above it.
But you cannot get the minimum. You can only have an excess or a little above. So I'm sure it's that minimum that confused you. So in calculating your margin of safety, you cannot have a minimum that, okay, if 200 is my break-even point, can I have a minimum of 210? No. So 210 may be a minimum. 205 could be a minimum. 201 could be a minimum. So minimum is English that you cannot define. But if you say excess, anything 201, 202, 203 is an excess. But if you say minimum, so I think where you had issues is the English, not in context. It's English. So if I were to pick the option, I would say excess, because excess does not depict a particular amount. It's just an amount above the minimum.
But
so the excess.
My L and move on.
Sorry, come again. I didn't catch that thought. The network broke.
I said it's the because it said budgeted.
Okay. Budgeted. Yes. So if you look at the lectures, we talked about budgeted revenues. So a little bit above what you budgeted. So if you budgeted 200 amount of revenue to a 200 amount of cost, that is what you budgeted. Revenue 200 will make you break even. But a little bit above excess of that revenue is what your break or margin of safety is all about. An excess above 200, 200, 201, 202, 203 is an excess. And that is what break-even talks about.
Yes, okay.
All right. So number 5, what is the limitation? And all of them too failed this. Okay. Salma got it too. Salma got it. Only Aisha failed it. Salma got this one. So which of the following is a key limitation of CVP analysis? Remember that sales mix remains constant is a limitation.
Yes.
And why is sales mix remaining constant is that the limitation of CVP assumes a constant proportion of different products sold. So where you have only one product is unrealistic in dynamic markets. And that is why A assumes all costs are fixed. No. CVP analysis differentiate between fixed and variable cost, and that is why you are wrong. All costs are not fixed; they can be fixed and variable. So CVP does not assume that all costs are fixed. So the answer is B. It assumes that sales mix remain constant, which is a limitation. It's not possible that sales mix remain constant. So you could also kill a product. A product cannot stay in perpetuity or forever. So this assumption is one of the limitations of CVP analysis. So I'm happy you guys did 3/5, even though you still did above average, 3/5, 3/5. So at least I'm going home with 20%. No, I'm even going with 40%. Wow, 60. You guys did well. So if you guys can score 60% in case study, I mean, you'll be so happy for you.
I don't even want 60.
No, please aim above 60. I always tell my students to always aim high, so that even if you come low, even though when I was writing, I went to aim for, I aimed for 75. When I was writing my score, I had this goal setting book that says write